In this video, I'm going to answer some questions about subprime loans and what exactly are subprime loans. It's funny, the term subprime makes you think of like subprime rate or some kind of like, subprime interest rate loan. It doesn't actually mean that. Subprime loan really refers to banks lending money to people with subprime or suboptimal credit ratings. So, your average good quality credit rating is probably going to be a 720 FICO score or above. Very good would be 750 and above. If, if you're below 580, you're probably not going to get a loan at all. I mean, maybe you will, but probably it's going to be very hard. Probably generally the range of subprime loans falls for people within the 600 credit range. And when you're getting a subprime loan, you're essentially, well, it's more difficult to qualify at a lower credit rating, but people will offer loans to people with lower credit ratings, but charge them more interest or less favorable loan terms or, something. They get something extra for taking on the extra risk of lending you the money. Oftentimes, people with subprime credit getting their first home or maybe trying to start a business are going to be utilizing the benefit of government programs like the FHA or the SBA to help qualify for the loan. So if you are looking for financing for either home or business, you could check out the FHA website or the SBA website, and you might have more luck there. But honestly, you could certainly, with business loans, you can go to the SBA and get more favorable terms with great credit as well. Now, people ask, do subprime loans still exist today? And what about subprime loans in the financial crisis? What happened there? In the financial crisis, subprime loans were taken to a whole new ridiculous level. So not only did you not need to have very good credit or could you get a loan with bad credit, but they were doing loans like things called stated loans where you just state your income, but they don't actually verify it at all. Or you can get a loan with, adjustable rate interest rate that only lasts for 3 or 5 years, and you do a loan where you only pay interest for the first 3 or 5 years, and then not only does the interest rate adjust, but you start paying interest and principal down the road. Naturally, with those types of scenarios, banks ended up lending money out freely to a lot of people that not only were credit risks, but just simply didn't make enough money to continue to pay those loans in the long term. And if and when the loan adjusted to a higher rate, the payment just got so big that, they couldn't even remotely afford it. Hence, so many loans got defaulted on, and, therein lied the crisis. These days, while you still can get a subprime loan, there is no longer a scenario where you can just say, I make this much money, and they don't go verified. The income verification aspect of lending is much more stringent today. And again, while, you might have some credit problems history or bankruptcy or whatever, you can get a loan at a higher rate or with, essentially less favorable terms, but you're still going to have to verify your income and verify the fact that you can pay the loan back. So luckily, I think it's a good thing that lending requirements are more strict today, but there are still options out there for people that do have damaged credit or have had a foreclosure or bankruptcy or something like that in their past, but obviously want to get back on the right track, borrow money, buy a house again, start a business, and do whatever. You're just going to pay more on the interest rate and maybe have some other potential unfavorable terms, but you will have options at least, so that's a good thing. There you go. That's what I have to say about loans. Bye.